Howdy, Jacob here. Today we're looking at FirstService Corporation in the real estate management and development industry. 7.8 billion market cap on 8.8 billion enterprise value. They provide residential property management and other essential property services to both residential and commercial customers in the US and Canada. Revenue growth has been astronomical, double digit every single year for the last 10 years, with a growing gross margin, although small, still growing. Operating margin as well as a percent is still growing. So obviously the operating profit and gross profit itself are growing immensely. I was talking about the margins. So we do see a pretty minimal return on invested capital in the low single digits. So nothing crazy impressive about that. But that revenue growth is definitely astounding. Don't really see any R&D, so just cost of goods sold, sales, general, and admin being their largest costs. Outside of that, really, that's pretty much everything. 228 million cash on hand with 1.2 billion long-term debt. So we can see that they did leverage this return a little bit. So obviously, if you grow a business 5% with no leverage, I mean, you can definitely, as long as it is growing 5%, you can make it look like a 10 or 15% return, depending on how leverage you are. And so we do have an increase of long-term debt from 222 million to 1.3 billion. And so that is partially the reason for the heavy increase. But in relation to their free cash flow, I mean, I guess it is still over 6 years of their free cash flow to get to that long-term debt figure. So me personally, I like it to be definitely less than 5. I like it to be around 3 because I think 3 gives you advantages to where you can increase debt if you find an absolutely astounding opportunity that's going to give you very high probability of success and a very massive return. You'd want to lever that a little bit. I think you're better to have that option. But once you're at 5 or 6 years of free cash flow, to go into more debt is just a lot of risk at this point. And so to me, I mean, they might have a little bit more debt than I would like, but with the growth that they've had, I mean, you can also see their free cash flow has grown from 67 million to over 170 million. And so you have over 3 times the free cash flow. So even on a basis, if you don't increase your debt, but you increase your free cash flow 3 times and you had an 8-9 ratio, now it's just a 3. Because again, that if that denominator or if that numerator doesn't change of debt, but that denominator gets bigger, your free cash flow, then obviously that figure becomes more attractive. And so for me, I will likely put in a little bit of debt reduction in their capital allocation. But outside of that, I mean, they've been heavy on acquisitions. They do pay a dividend. I'll probably have to balance that out. So let's get right to it. For revenue growth here, I mean, they've been growing like crazy. Again, like I said, been leveraged a little bit, a lot of acquisitions. So maybe let's dampen it down to 8% or so. And for margins, still trying to figure out where their margins are. They're pretty low, averaging 3 and 4%, which we can see here was pretty high or highest post-COVID, and then down a little bit. Free cash flow is pretty close to where it's been at its peak. So I think I'm pretty comfortable with like 3% margins there. Share change, it's not really any of their capital allocation. They do issue shares through stock-based compensation, or at least issue options to buy shares, but it's a pretty minor amount. So let's say it's roughly flat. Terminal value, this is the most subjective part of this whole thing. Growing through acquisitions, but they are being somewhat efficient with them. I would like to see, when companies grow their revenue, I'd like to see the bottom line grow even more, and we are kind of seeing that. Maybe the last couple of years down a little bit, though. I mean, I still think it's better than an average company. So let's go a little bit above market average here. Maybe a little higher. Let's do 18. And then for the dividend, have they grown that in the past? They definitely have. Let's grow that with revenue because it's still a reasonable payout at this point. 40 million in relation to their 170 mil or so free cash flow earned. And so this is kind of assuming, maybe what is that? Like 20 to 30% to a dividend, 40% or so to acquisitions, and then 30% or so to debt reduction. I think with that free cash flow growing and paying down debt a little bit, by the end of 7 years, they'll probably get to 4 to 5 times free cash flow to have as a debt figure. And I think given their market cap and how fast they're growing, it's probably pretty reasonable to me. So I think it's a great company, one that's growing like crazy. I think if you really understand this business and you're confident that they can get 5% or so margins, grow double digit for the next decade or so, it's probably a great price right now. But given what I'm seeing right now, this is probably the best I'll do for projection purposes. Hope you enjoy this video. Have a great day.